Hello everyone and welcome to the Finance and Risk Corner. This is your new YouTube channel to understand finance the right way. My name is Jad. I've been teaching the CFA program for more than a decade, all 3 levels of the CFA exam. So I'll be happy today to help you guys if you're preparing for your CFA exams, but not only. If you have an interest in finance and risk management in general, I will help you understand the concept the right way. So let's start today with how well do you understand your NPV and IRR? This seems like a very easy topic, but you'd be surprised how few people can really interpret the NPV correctly. Let's take a step backward and ask ourselves the question, why do we discount future value of cash flows to find the value of an asset today? So who invented that concept and why is it something that we use and we take it for granted? So imagine you have a project that would return a single cash flow of $100 exactly 1 year from now. And the big question is, how much would you invest in that project today? Again, given that it will give you $100 exactly in 1 year. And the right answer is, it depends. It depends on how much risk this project carries, or in other words, what is the required rate of return that you would require from that project, again, in order for you to accept to invest in that project. So if you look at this part of the slide here, you would see that with a risk of 0, the actual return that you require is the risk-free rate. And then the higher the level of risk of a particular project, the higher the required rate of return. You would ask for a higher rate of return to accept to invest in a project if it is riskier or if it carries more uncertainty. So again, we have a project that will pay you $100 exactly 1 year from now. So let's assume that you did a careful analysis and you decided that 10% is the required rate of return. In other words, you would be willing to invest in that project if it earned you 10% per annum. So how much should you invest in that project? To solve for the amount of money L that you would invest in that project, knowing that you require a 10% rate of return, and also knowing that you will be given only one cash flow of $100 in 1 year, you would think in the following way. So the amount L that I would invest, it should be returned to me plus a 10% return on that very same amount L. And knowing that we will only get one cash flow of $100, then this $100 should exactly do that, i.e. return our original capital and a 10% profit on that original capital. This would allow us to write this equation, L, which is the amount of money that we are willing to invest, multiplied by 1 plus 10%, which again ensures both the return of the original capital L, but also a 10% return on that amount. This should be equivalent to the $100 that they will give us 1 year from now. Please understand that the $100 that you will earn in 1 year actually does all of that. It returns your original capital and it remunerates your original capital by 10% of profit or return. So writing that equation and then solving for the amount of money L would actually go this way. You would discount the future cash flow at the required rate of return of 10%. So 100 divided by 1 plus the required rate of return would give you $90.99. This is the amount of money you are willing to invest in that project, and this is the amount of money which would earn you 10% on that project, knowing that you will earn back $100 1 year from now. This is a fundamental concept in finance, and this explains why we actually discount future cash flows to obtain a value for any instrument or project today. We should not take this concept for granted. By looking at it from this angle, you guys understand that there is a very important, strong, and implied concept. Anytime you discount a future value at a required rate of return, you are implicitly asking for this project to return the required rate of return. So by discounting the 100 at 1 plus 10%, you are implicitly asking that project to earn you 10% per annum. Of course, it's a 1-year project. Still, it is a 10% per annum. Now, let's calculate the net present value of that project. So remember, it costs $90.9 to invest in, and it will return $100 1 year from now. We have decided that the required rate of return is 10%. So you're all familiar with the formula for NPV, especially if you're preparing for the CFA Level I. So to find out the NPV of a project, first you have the initial cash outflow. That's a negative, of course, because that's the amount of money you disperse. That's a negative cash flow. That's an outflow which you pay to acquire the project. And then you have the positive cash inflows, right? The $100 that will come 1 year from now, so it must be discounted at 10%. If you calculate the NPV of that project, the answer is $0. So what does this NPV equal 0 mean? A lot of people would tell you this is a project that has no value. It makes no sense in investing in that project. Others would say we are indifferent whether we invest in that project or not. In all cases, let's make sure that we have the right interpretation and understanding of what an NPV is. To do that, let's take a different scenario. So in scenario 1, let's assume the project is still the same. It still gives you $100 1 year from now, but for some reason, you can buy it now instead of 90.9, you have to buy it for 93.9. Now let's calculate the NPV. The NPV would be negative 93.9 plus 100 discounted at 1 plus 10, which is the required rate of return, for an answer of negative 3. This is a negative NPV, and we are taught to not invest in projects with negative NPVs. But sometimes we are taught for the wrong reasons. Some people would say this is not a profitable project. This is a project that is losing money. I just want to attract your attention that this project would make you pay $93.9 and then earn back 100. So from an accounting perspective, it is absolutely not a losing project. It's a profitable project. You invest 93.9 to collect 100 1 year from now. This is $6.1 in profit. Yet the NPV is showing a negative number, negative $3. So how should we interpret this negative 3? Now also consider scenario 2. So the project is still the same, $100 in 1 year, required rate of return of 10%, but for some reason you can now acquire the project for 89.9. And when I say project, it can be a financial instrument or it can be a real project like opening a shop or a restaurant. So it would now cost you 89.9 to acquire that project. Again, it still pays you $100 1 year from now with a required rate of return of 10%. Calculate the NPV now. It's negative 89.9 outflow to acquire the project, and then the same $100 inflow in 1 year discounted at 1 plus 10. The NPV is a positive $1. What is again the correct interpretation of the 0 in this case, the negative $3 in that case, and the positive $1 in this case? When we have an NPV of 0, you cannot say that the project is earning you 0. The real interpretation is that the project earned you the required rate of return of 10% plus $0. This is how we actually interpret an NPV. Let's continue, things will become clearer. In scenario 1, the NPV is negative $3. Does this mean that the project is losing money from an accounting perspective? Absolutely not. One more time, you invested 93.9 only to collect $100 1 year from now. This is a $6.1 return. Yet, the NPV is showing a negative $3 value. The correct interpretation of that is that the NPV underperformed its required rate of return. Whenever you see a negative sign, it automatically means that the NPV returned less than, or the project returned less than what it was required of it. It was required of the project to return 10% per annum, it returned less. The minus sign is automatically telling me this project earned less than its required rate of return. Now, what does the $3 mean? It means that the project earned less than the required rate of return by an amount of money that is worth today $3. Now, how do we interpret the NPV in scenario 2, where the NPV is a positive $1? This project, when I see positive, again, it means that this project earned more than the required rate of return. We know for a fact that it earned more than the 10% we are requiring from it. Now, by how much more did it earn? an amount of money that is worth today $1. So let's look again at the zero. Following the same interpretation, the project earned 10% that is required of it plus $0, which means that it exactly earned 10%. This is the correct way to interpret an NPV. When the NPV is negative, it means that the project earned less than the discount rate that is required of it. We know for a fact that the project earned less than 10%. When the NPV is positive, we know for a fact that the project earned more than the required rate of return. In our example, more than 10%. And when the NPV is zero, we know for a fact that the project exactly earned the 10% that is required of it. And that's nice to know. Let's take a more realistic example. So we have a project with an initial required investment of $10 million. It will generate cash flows for the next 3 years of $4 million, $8 million, and $3 million respectively. The required return on this project is 11%. So we calculate the NPV, which would be equal to a positive 2.29 million. Of course, CFA Level I candidates can use their financial calculators using the NPV and cash flow function. Once we have the NPV equal to positive $2.29, we now know how to provide a perfect interpretation. So this project earned the required return of 11% per annum. How do we know that? We know it for a fact because the NPV is positive. It means that we earned more than the required rate of return of 11%. How much more? By an amount that is today worth 2.29 million. We earned more than the 11% that is required from us per annum. So this is a 3-year project which earned every year 11%. And also an excess amount of money above the 11%, which represents today 2.29 million. That's a great thing to know how to interpret an NPV. Now let's think about it further. So what you know now, since you can now interpret an NPV, you know that the project earned more than 11%. How much more? By an amount of money that is worth today $2.29 million. So you could say that the project earned you 11% plus $2.29 million. There's a problem in this interpretation because we are combining a percentage return with a dollar return, right? You would, I'm sure, want to know how much exactly did the project earn in percentage. It is already excellent to know how to interpret an NPV and say, yes, I know that this project earned the 11% that is required of it, plus an amount of money that is worth today 2.29. But it's even better to say, you know what, this is equivalent to 16% or 18%. So the next step would be to merge those two return measures to combine two things that are not easy to combine, a percentage return with a dollar return. We will now make sure to include that dollar return, per annum of course, into the 11% and come up with one single percentage. And this is the role of an IRR. And you guys will be able, after this video, to really connect the dots and understand why the IRR is calculated the way it is. But please remember for now that the role of the IRR is actually to give you one unified rate of return. It is nice to say this project earned 11% and an amount of money on top of that 11%. But can you tell me exactly how much the project earned in percentage? Enters the IRR. So let's say you proudly announce, I have a 3-year investment project that will yield 11% per year in addition to an amount of money that is equivalent today to 2.22 million. As I said, the IRR's role in life is actually to merge, to combine those two measures and come up with one unified example. For those who are already familiar with an IRR, you are taught to compute the IRR by setting the NPV equal to 0 and solve for the discount rate that makes the NPV equal to 0. You can now appreciate why the formula is written this way. Now that you know how to correctly interpret an NPV, you know that if the NPV is 0, it means that the project achieved the required rate of return plus 0, which would simply means that the project exactly achieved this required rate of return. By setting the NPV equal to 0 and solving for the discount rate that actually makes the NPV equal to 0, you are perfectly building on your flawless interpretation of NPV. So if we do that, we would get an IRR of 24%. Now let's use the way we interpret an NPV. This project earns 24% per annum plus 0, which was exactly our objective, to merge the 11% that we earn per annum with the 2.2 million split across all 3 years. And the 24% is actually doing that. Instead of saying I earned 11% per annum plus an amount of money X, which is 2.29 million, you can simply say I earned 24%. One more time, it's not a coincidence why we set the NPV equal to 0 and we solve for the IRR. Because we know that the discount rate that makes the NPV equal to 0 is actually the rate that the project would have returned plus $0, which means we would have isolated the unified rate of return that the project would have returned. By the way, this is an iterative process. So you can't really isolate IRR in a closed-end formula, and CFA Level 1 candidates can confirm by actually calculating the IRR on your calculator. You would see that even your calculator would take like a second or a bit more to solve for the IRR. This is because the calculator is doing an iterative process. In real life, you would either use numerical methods or some mathematical methods, or you would actually iterate. You would choose an IRR of 20 and then check whether the NPV is positive or negative. And you would adjust your IRR until the NPV reaches exactly 0. Of course, fortunately for us, we don't have to do that and waste our time. We can use the financial calculator, solve for the IRR, and the calculator would give us 24%. But you guys would notice that even the calculator is thinking because this is an iterative process. Excellent. Now that we know how to calculate an IRR, how to interpret an IRR, and why the IRR exists in the first place, which I remind you again, it is to unify the NPV, which shows you performance in terms of a percentage and the dollar amount. The IRR is there to combine those two measures. And by the way, this also makes you guys understand something and not memorize it. You are used to reading in textbooks that whenever the NPV is 0, then the IRR is higher than the discount rate. Whenever the NPV is positive, the IRR is higher than the discount rate. Of course, now you can connect the dots. Because when the NPV is positive, you know that the project achieved more than the discount rate. More than the discount rate by a sum of money. So by definition, the IRR must be higher than the discount rate because the NPV being positive, the project earned more than the discount rate. If the NPV is negative now, you know for a fact that the IRR is lower than the discount rate. One more time, it's easy to connect the dots. If the NPV is negative, we interpreted it as a project that earned less than the required rate of return. Discount rate is also called required rate of return. So when the NPV is negative, the project earned less than the required rate of return by X amount of dollars. When the IRR unifies those measures, it is only natural that the IRR will be less than the discount rate or the required rate of return. Now, of course, as powerful as the IRR is, it is not flawless. It has many issues, many drawbacks. Be ready to understand those for your exam, but also in real life when you calculate the NPV and the IRR of a project. So first, the IRR assumes that all interim cash flows will be reinvested at the IRR itself. So let's go back to our project, right? So here we have a 3-year project with an IRR of 24%. When we calculated the IRR equal to 24%, this will only hold true, i.e. the project will only earn you 24% per annum if each interim cash flow is actually reinvested at 24%. So the assumption is whenever you earned the 4 million in cash flows in year 1, you have reinvested those 4 million at 24% for the remaining 2 years. Same would go for the 8 million that is earned in year 2. The assumption is you have reinvested this 8 million at 24% for the last remaining year, which is not really realistic, because it's like assuming that if you have a restaurant, then any cash flow, anytime you have a client paying, right, every day, you immediately take that cash flow and you reinvest it in a new restaurant, which is not possible, in practice. So the IRR will typically overstate the profitability of the project. Remember, 24% is only correct if you manage to reinvest your interim cash flows at 24%. Since you cannot do that in real life your interim cash flows will probably be deposited at the bank at a much, much lower rate, provided that you are cash rich, you have liquidity. Even in that case, you fall very, very short from the 24% assumption behind the IRR. So when you guys calculate the IRR for a project or on your exam, remember that in real life, you are most probably overstating the profitability of the project. The profitability is actually lower, unless you can actually practically reinvest every interim cash flow at the IRR. Second drawback. The IRR, as you saw, is the rate of return, is the discount rate that makes the NPV equal to 0. Sometimes you have two IRRs, you have two different discount rates that can make the NPV equal to 0. So which one is the correct IRR? You cannot really rely on the IRR in that case. When does this happen? This typically happens when you have a project with an unconventional cash flow stream. When I say unconventional, it means that it departs from this scenario. So the typical scenario is you have a negative cash outflow, right, at the beginning to invest in a project, and then you have a series of positive cash flows that flow in. This is a conventional cash flow stream. An unconventional one would be a project where you have to invest money twice or more. So you start by acquiring the project in year 0, then you have some years of positive cash flows, then at some point in time there is a second cash outflow. Whenever this is called an unconventional cash flow stream, anything that is not negative followed by a series of positive cash flows. Whenever you have this, then you would easily recognize that there are two different time periods where the NPV can equal to 0. So two IRRs can exist, which would make the NPV equal to 0. Which one is the correct one? You cannot really rely on the IRR. And that's an issue, that's a drawback for IRRs. Some projects simply have no IRR, right? You cannot calculate an IRR, so you don't have one in the first place to actually build on. This could happen when a project is immediately profitable in the first year, or immediately the cash inflows are higher than the cash outflows. So at no point in time, the NPV can go to 0. It can also happen if the cash flows are always negative. There is no rate that could actually make the NPV equal to 0, so no IRR. The last drawback is if you have two projects, A and B, differing in terms of IRR and NPV, you might be tempted to choose the one with the highest IRR, but in reality, this could be actually not the right idea. An easy way to understand this is to imagine an extremely profitable project, but with a very low cash investment. So imagine you have two IRRs, right? A with IRR of 55, but an initial investment of 10. So you're basically achieving 55%, which is an amazing rate of return, but on a very small investment amount. I'm sure you'd be much more interested in going into project B with only 10% IRR, but a much larger initial investment amount, which would translate in higher profitability and higher shareholder value creation. And this is also a drawback for IRRs. Let's end and perfect our understanding of net present value. Why do we use cash flows? This is a typical question that CFA candidates have. Why don't we use net income? So when we calculated the net present value of a project, you will always remember that they will give you the cash flows. They will not give you net income. So why do we do that? Is there any particular reason why we do that? Of course there is. We want to avoid double counting some expenses like depreciation. Consider the formula for NPV. It's negative the initial cash outflow plus the present value of all cash flows discounted at the rate of return from 1 to 10, the initial cash outflow happening at year 0. So look at the initial cash investment. It represents your investment to acquire the project, including to acquire some equipment, some machinery, some plants, etc. Those will be depreciated. And when they are depreciated, they will actually hit net income. If you use net income here, you would be hitting your project twice by those depreciation expenses. One, because those depreciation expenses are already sitting in your initial investment. You are already removing the whole initial investment from your NPV, which also means that you are removing the depreciation part. If you also use net income instead of cash flows, then net income, as you guys know, is already reduced by depreciation expenses. You would have reduced those depreciation expenses twice. Once, because they are an inherent part of the initial investment. It is the initial investment that you actually depreciate over time. And a second time, because net income would also be reduced by those same depreciation expenses. This is why we use cash flows. So what about the depreciation expense? We add it back to net income. To calculate the cash flow, we take net income and we add back the depreciation expenses. And I know that some instructors and some candidates would say that the reason we are adding back depreciation is because it's a non-cash expense. Absolutely not. This is not the correct answer. This is not the correct reason. We are adding back depreciation because we don't want to double count it. It already exists as a value within the initial investment, so we don't want to hit our formula twice with the same expense. We do not add back depreciation to net income because depreciation is a non-cash expense. We add it back because we want to avoid double counting. And to convince yourself that this is the reason why we do that, what about interest expenses? You guys know that to calculate the cash flows, we actually add back depreciation to net income, but we also add back the after-tax cost of debt, which is interest expense, adjusted by 1 minus t. Now, if you answer that the reason we add back depreciation is because it's a non-cash item, then why do we add back interest expense? If you know a bank that charges you interest without actually taking them, then you are very, very lucky, right? So interest expense is also added back, and it is added back for the exact same reason why depreciation is added back, which is not because those are non-cash expenses. Interest expense is actually added back for the following reason. Because once you calculate the NPV, this is negative I0 plus the cash flows discounted by 1 plus R. You add back interest to net income because the interest expense is also embedded in the discount rate. In later sessions, or if you already studied your curriculum, you guys know that the discount rate is the weighted average cost of capital, which takes the weight that you have in equity multiplied by the cost of equity, plus the weight that you have in debt multiplied by the cost of debt adjusted by 1 minus t. So once you calculate your cash flow, you know beforehand that this cash flow will be discounted at R. You also know that R already includes the cost of debt. It already reduces the value of the cash flow by the amount of any interest expense that you paid. And this is why you need to add back the adjusted interest expense to net income to calculate cash flows, or else, guys, one more time, you would be double counting interest expense. If you don't add it back to net income to come up with a measure of cash flow, then you would be hitting yourself with your interest expense in the numerator, but also in the denominator, which factors in the cost of debt that you pay to your bank or to your creditors. So this is the reason why we add interest expense back, because we don't want to do double counting, just like we did for depreciation expenses. Now, one last question that might be entering your mind at this point is, why do we add back interest expense adjusted for 1 minus t? 1 minus the tax rate. And this is because when you pay interest, you actually lower your profitability and you escape some taxes. And a very easy way to see it is to look at the following example. So imagine you have companies A and B. So company A has sales of 100, has cost of goods sold, let's say of 40, and has general expenses of 10. So the before tax income is 50. And let's take a 50% tax rate. So $25 will be taken in taxes for a $25 net income or profit. Now imagine that B is identical to A, except that it has interest expense of 10. That's the only difference. You guys should not expect that the net income of B would be $10 higher than the net income or $10 lower compared to the net income of A. And this is because when you pay interest of $10, you also escape some taxes because your profitability is reduced. So when you pay expenses, when you pay interest expenses, of course, it's an expense, but on the bright side, you are escaping some taxes. And let's see this in numbers. So the sales are also 100, with COGS also of 40 and general expenses of 10, to which I will only add $10 of interest expenses. This would give you earnings before taxes of 40. Now, with a 50% tax rate, taxes are taken equivalent to $20, and the net income of that company is 20. This is only $5 less compared to the company that has no interest expenses and not $10 less. One more time, because when you pay interest expenses of $10, of course, there is a hit of -10, but at the same time, you have $10 less in earnings before tax. So those $10 less in earnings before tax will actually escape the 50% tax rate. So you have a savings of $5. That's the 50% tax you no longer have to pay on the $10 because you have a $10 less in profitability. Now, if you combine those, the difference is exactly $5, which is the difference between 25 and 20. This is why when you guys add back interest expenses, you don't add back the $10 of interest that you paid. Because if you had not paid those $10, you would not be richer by $10. You'd be richer by only $5, as you can see in this example. And this is the reason why we add interest expenses adjusted by 1 minus the tax rate. So here we go, guys. I hope you enjoyed this video. There will be other videos on other topics for CFA Level 1. There will also be other videos for CFA Levels 2 and 3. So stay tuned. If you like the video, please like and subscribe to this YouTube channel. We will make sure to update it on a weekly basis and cover all sorts of concepts, formulas, and topics for the CFA Level 1 exam. So please send us in your comments any topic, any formula, or any concept that you guys are finding difficult, and we will make sure to cover it with a video very, very soon. Thank you again, and see you soon.